Hello, welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex, stocks and commodities in multiple destinations. My name is Michael Hewson, and joining me again is Pepperstone Senior Market Strategist Michael Brown. And this week, we've seen equities come off the back of several days of gains, well, the FTSE 100, several days of gains. And in April, that actually could have been an awful lot worse when you consider the start to the month that we actually had. End of the month, volatility's little bit more subdued today, given the fact it's a European holiday. Germany's off, and I think Paris is off, is closed as well. So, initial thoughts after a very turbulent April, Michael?
Yeah, well, very good afternoon to you, mate. As you say, I think could have been worse is probably a good summation of things. I think if you, logged out of your terminal and went and sat on a beach on the 31st of March and came back on the 1st of May, you'd go, well, that was a quiet month. Of course, those of us who lived the reality of it will know that is absolutely not the case. But I, for one, am certainly surprised with the speed and the ferocity with which we've seen markets pretty much across the board, whether that be Europe, Asia, even on Wall Street now, reclaim all of those declines that we saw in the after of Liberation Day right at the start of the month.
Yeah, I think one of the things I've taken away from the last 4 weeks is that, Donald Trump started off shouting very, very loudly, but he's had to walk quite a bit of it back. But I think what it's introduced into the overall dynamic of financial markets, and we'll talk about this after I do the risk warning, is that market reality hit him very hard around the chops.
Yes, although I would stress bond market reality, not equities necessarily.
Yeah, absolutely. But even bond markets, I mean, they pretty much finished the month
again where they started. So why did we all waste 4 weeks of our life on that nonsense?
Indeed. Anyway, without further ado, let's do the risk warning. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own financial advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 74.8% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So, basically FTSE 100 just below 8,500. It finished March at 8,580. Hit a low of 7,538 in April. So we've had about an 800 point round trip. The DAX finished April slightly higher from where it closed in March, despite a low of 8,815. It closed at 22,500, give or take, at the end of April. So, what's that all about?
Well, you may well ask, mate. You may well ask. I think there's a few things at play. Obviously, firstly, you go back to the middle of the month. This 90-day pause in reciprocal tariffs, it kind of took out the worst case scenario outcome from the whole thing, which I think markets clearly reacted positively to. And I think over the last couple of weeks, there's been a little bit of a school of thought growing that we may be sort of at or past the point of peak noise on the trade front, although I would stress that, clearly we've still, well, at the time of recording anyway, yet to have actually any sort of concrete deals or agreements having been made. And I know we're going to get into this in a short while, but actually barring the sentiment surveys that we've had, actually economic data for now is holding up relatively well, and earnings season has probably been, in terms of the figures themselves, better than participants have been expecting. So you sort of put all that together, and clearly the economy as a whole is absolutely not out of the woods, and I'm not entirely sure the market is out of the woods either, but definitely we're ending April and starting May on much more of a positive note than we started last month.
Yeah, and I think one of the things I've taken away, from the past couple of weeks is the absence of all of the, the usual thing that comes out prior to May, sell in May and go away. I lost count a number of times when I was at CMC. I was asked to write something on this rather tired subject. You get a bit jaded about it after a while.
Well, the other thing I would say is most people probably sold in April and went away this year, and now they've bought it back. So there's almost nothing to sell.
Yeah, I wouldn't say that. I mean, I think one of the things that has encouraged me about recent stock market movement has been the extent of the rebound, which suggests there's still an underlying demand there to own equities. And despite that, you're hearing an awful lot more people starting to become an awful lot more negative about the economic outlook, but more positive about the prospect of multiple rate cuts. Now, that certainly wasn't the case a month ago. Only this morning, in the wake of the UK data that we got out, we've had a number of US banks calling for at least 4 rate cuts between now and next year. Now, obviously, we've got the Bank of England next week. We've got the Federal Reserve next week. We've also got US investors talking about the possibility that we could actually get more than, say, 1 rate cut from the Fed by the end of this year. So the narrative is shifting slightly, and I think that is being reflected in the fact that bond yields have settled down. Your thoughts on that?
No, I would agree with that, although I think we probably discussed this before. I think there's a notable difference in how central banks in the rest of the world will likely react compared to how the Federal Reserve are likely to react. Because for the rest of the world, the implications of tariffs are very, very clear in that they bring significant downside growth risks, which will obviously be most significant in those heavily export-dependent economies, such as the Eurozone and China, for instance. But they also bring a big disinflationary impulse with them as well. Whereas in the United States, you have the downside growth risks, but an upside inflation risk, at least in the short term over the next couple of quarters, as the cost increases from tariffs are ultimately passed on in the form of higher prices to consumers. So from a policy perspective, it's actually quite easy for the Bank of England to sit there and go, well, tariffs are going to give us a bit of a helping hand in terms of getting inflation lower sooner, or at least smoothing the profile out a little bit. And it's the same with the ECB, which in turn gives them room to cut more quickly and deeper to provide some support to the economy. But the Fed find themselves stuck between a bit of a rock and a hard place. Ultimately, on the one hand, you've got risks that inflation is going to continue moving higher and expectations potentially become unanchored from the 2% target. But on the other hand, you've got a risk that the economy is going to slow very, very rapidly and unemployment is going to rise quite considerably. So I think the reaction from the Fed will be more of this wait and see approach, whereas actually everyone else in the rest of the world has got a bit of an easier job where you kind of just go, let's keep lowering rates as rapidly as we can.
Well, we'll circle back to that in a minute because of when we preview the Fed and the Bank of England next week. But in terms of actual earnings, it's been a pretty positive week. And I'll basically tee this up for everybody. What we're going to be discussing is the earnings numbers that have come out pretty much since Alphabet's numbers, Google's numbers, last Thursday night. We've also seen a decent set of numbers from companies, big UK companies, AstraZeneca. We talked about it last week. Associated British Foods, Barclays, Lloyds, HSBC, and
the list goes on.
BP. BP's in particular, we're talking about, and Rolls-Royce actually published a trading update as well as a little bit of a side show to its AGM. And as I'm talking to you now, Rolls-Royce shares are currently up around about 2%. So let's start off with obviously 2 of the biggest FTSE 100 companies, AstraZeneca and HSBC. Now, AstraZeneca, decent set of Q1 numbers, 7% increase in revenue, 34% rise in profits. Shares are lower. Why?
You may well ask, Mr. H. You may well ask.
I mean, 2.3% down today. They are slightly higher over the course of the past couple of days. For me, I'm struggling to get my head around the idea that this sort of exceptionalism when it comes to profits for a big pharma company prompts what is a fairly subdued reaction from the markets. I mean, maybe there's risk going forward, and we talked about it last week.
Yeah, I was going to say, I guess that is perhaps the catalyst. I mean, as you say, there's really nothing to complain about in terms of the results. You think about the global landscape, though. I mean, the downside risks for not just AstraZeneca, but the pharmaceutical sector more broadly are very significant. We're still waiting for news on the tariff front, the potential for drug price changes in the United States. So it may well have been a case of, the stock was almost priced to perfection, and now the earnings are out of the way. It was just a bit of an excuse to take a little bit of risk off the table and see how the land lies in a few weeks or so.
Yeah, I still struggle with that because the shares basically rebounded off 1-year lows at the beginning of April compared to where they were in the middle of 2024. They're trading at still a fairly significant discount. Anyway, so that's AstraZeneca. Had a bit of a rebound below their 50 and 200-day moving averages. I think as long as the April April lows hold, then perhaps there is potential for further upside. But at the moment, I don't really have a view either way on that. HSBC, Q1 results, bit of a mixed bag, all told.
Yes.
Their shares were hit quite hard on the back of concern about the damage that US-China tariffs could do to its Asia base. The shares hit lowest level since November in early April. They've rebounded a little bit, but it still looks like a fairly subdued rebound. Any thoughts on HSBC?
Yeah, I mean, as
Profits
you
were
said,
down.
well, I was going to say a mixed bag. I would actually say that there wasn't particularly much to like about it. As you said, profits lower, net interest income was lower, revenue was down 15, 16% year on year. I mean, I guess maybe you could argue that the $3 billion buyback and the dividend have sort of softened the blow marginally. But yeah, it's one of those where you sort of look through the slate of earnings and go, actually, on balance, a lot of this is much more pessimistic than it is optimistic.
I mean, one of the reasons why profits were lower was down to the fact that in the same quarter last year, there were some one-off gains booked
That's very true.
due to the sale of its operations in Canada and Argentina. Obviously, because the global operation is smaller, revenues will be lower as a consequence of that. Net interest margin was also lower than a year ago, which I find a bit strange given the fact that generally gilt yields have been higher, and Lloyds today posted an improvement in its net interest margin.
Yeah, that is a bit of a confusing one. I must admit, I was surprised by that. I guess the other sort of consideration with HSBC is yet again they're going through a restructure, and there's all these promises being made around the synergies that will produce, and I think they're talking about $300 million of cost reductions this year as a result of that. Again, there's a question of actually, are you going to achieve these numbers, or is this going to be something that actually hobbles the bank because they're too focused on the restructure as everyone else sort of bounds on without them?
There's also this talk about the East-West split and whether or not it's the precursor to potentially a breaking up of the bank between its Asia hubs and essentially the rest of the world.
Which is something that has been discussed for years, hasn't it?
That's not going to go away.
No, absolutely not.
It's not going to go away. Barclays, on the other hand, really decent set of numbers. 19% increase in pre-tax profits in Q1, £2.7 billion. Unsurprisingly, decent performance from its equities division, which you would expect to see given the fact that JP Morgan, Goldman's and Citigroup all posted some fairly decent numbers there. Revenues up 9% in equities trading, fixed income up 21%. Advisory was the weak spot, which you would expect it to be given the turbulence in financial markets. Why would people want to look at M&A and advisory and that sort of thing in such a febrile financial market environment? So looking at Barclays, the numbers look fairly good. And actually, one of the things that I took away from Barclays, and I also took away from Lloyds, was the fact that arrears remain low.
Yes.
So that brings me back to something that I referenced earlier today. Those mortgage numbers this morning, net lending to individuals saw a massive rebound, or not rebound, surge, 13 billion in March. And I think people could put that down, or people have put that down to the fact that obviously the stamp duty thing kicks in April. But that still doesn't make sense to me, because even if the lending goes up in March, the sale's still got to complete.
No, you're absolutely right.
And it will complete in April, May and June when the stamp duty goes up. I mean, that surge should have happened 3-4 months ago.
Well, I agree, but that's assuming a sort of normal time horizon for this to be completed, whereas I would imagine, and I do agree, and also you dig into the data, and actually the number of mortgage approvals in March wasn't actually that different. I mean, it's been hovering around sort of 65, 64,000 for the last few months. It was just the value that's shot through the roof. But I think the key takeaway from that for me would be, because everyone was trying to beat the stamp duty deadline, everyone was probably working to much more compressed timeframes than we would usually see. To be honest, I don't see any other reason why we would have such a huge surge in borrowing. But of course, what's important to bear in mind is in April and May and June, that surge is going to completely unwind, and you would expect activity in the housing market to slow up considerably.
Well, it already is. I think house prices have been in decline now, I think for the past 2 or 3 months. I think some of the recent data has shown a softening of house prices. I could be wrong. There are so many different house price surveys. You sort of tend to lose track of which ones are asking prices and which ones are actually agreed prices.
Yeah, and of course the other thing with, I'm sure our listeners will be aware of this, but the housing market in the UK, an average price is fine, but it is very much dependent on where in the country you are. I think the market in London, for example, is a very, very different market to that of, let's say, Northern Ireland or Scotland or somewhere like that.
Yeah, you'll always have regional variations, and where you're getting house prices cool down in London. Not surprising when you're hearing about wealthy people leaving.
Yes.
But in the more in the cheaper areas of the UK, they're actually holding up reasonably well.
Yeah.
Yeah. So HSBC's, I'm going to basically compare and contrast here. These UK results saw profits fall by £100 million, falling to £1.71 billion. Yet in Barclays' case and in Lloyd's case, the businesses look fairly robust, judging from the numbers that I've got in front of me. Talk about Lloyd's, because Lloyd's shares down 1.6%.
Yes.
Despite a fairly decent set of numbers. But I think one of the reasons for that was obviously this provision.
Yes, yeah, which was pretty chunky. They also saw a big rise in costs, in operating expenses as well. And also, as we were just saying, you look at earnings from the likes of Barclays, which were, very, very strong. Even the weaker parts of that report were sort of expected weakness in deal making and M&A and things like that. So the bar has been set quite high. And I think as we're seeing the market taking a relatively dim view of any softness, particularly where the bank, you could argue, should have a little bit of a greater degree of control over things.
I think one of the things I took away from all three banks is that while there's an awful lot of concern about the UK economy and economic slowdown and pretty much everything else, none of the banks reported any significant financial distress.
No.
Amongst their clients. Yes, credit impairments were higher. They were higher at Barclays at £643 million. In Lloyd's, they were higher, but £100 million of that was down to adverse effects as a consequence of US tariffs.
Yes.
So you could sort of see through that. Black Horse Finance, there wasn't really any mention of that. There's going to be a resolution of that, I believe, in July. They've already set aside £2.7 billion of Lloyd's with respect to that. I would be surprised if we hear much more adverse commentary about that, even after the court date in July. Hopefully it will be settled and a line will be drawn under it. But overall, Barclays UK results, 30 and 90-day arrears remain low. 0.7% for 30-day and 0.2% at 90-day arrears. Loans and mortgages are up. Customer deposits were down at Barclays, but in Lloyd's they were up. So all in all, maybe we're being too downbeat on the UK economy, or maybe it's the calm before the storm.
Well, I was going to say, I think I'll take the latter on that front. I think, and actually I'd say this about earnings season at large, not only in terms of the UK banks. I think, clearly things have progressed, or the results have been, on the whole, not as bad as everyone was expecting them to be. I think the issue is it's probably too early to sit here and say everything's fine and dandy. These are Q1 figures, remember? So a lot of the tariff and uncertainty and volatility aspect won't be, we'll be sat here in July for the Q2 earnings season talking about how that has impacted the data. So for me, it's potentially the calm before the storm. But if they weather Q2, then I may change my tune on that one.
They haven't downgraded their guidance. None of the banks have.
No, the banks haven't. Almost everyone else has.
Well, we'll come on to that in a minute. US companies aren't, the tech companies, we'll talk about that in a minute.
Yeah.
Their guidance is still very, very positive. So that's really the positive story. I think banks generally are painting a picture of an economy that, while there's an awful lot of uncertainty out there, at the moment, evidence of financial stress is fairly low. Now, obviously, that could change over the course of the next 3 months. But for the here and now, Barclays shares are near to the highs that we've seen earlier this year. I'm struggling to get through that 315p level. But they've come a long way since November 2023. So I think the catalyst for a move higher, I think if we were going to see a move higher, it would have been on those results. And the fact of the matter is we haven't taken out those highs.
Yeah.
So that is a little bit of a worry for me, I think, when it comes to Barclays shares. Strong set of results. The market hasn't really been able to take the shares higher. Lloyds Bank, we pulled off the recent highs again. Obviously, we were talking the end of last year about the potential for a move to a pound.
Mm-hmm.
Well, we're sort of halfway there. We've gone from 50p to 75, and now we're straddling around about 71, 72. We haven't really dropped, well, we haven't dropped back below 60. We managed to hold above 60p at the beginning of April, and now we're pretty much where we started. But again, decent set of numbers, improvement in net interest margin. Ultimately, the bank looks in a fairly decent state. And HSBC, well, that's a tougher one, because obviously you've got the Asia business, which is doing very, very well. The UK business is just about holding its own. So much will depend on how HSBC performs in Asia and how this trade friction between China and the US plays out in the coming months, I think, for HSBC.
Indeed.
Okay, so let's talk about BP. Not a particularly slick set of numbers.
Oh, God. That's terrible. There is no room on this podcast for crude puns. Come on.
Well, I just made one. So did you. The market didn't like those. I mean, obviously a lower oil price and a lack of confidence in senior management, and the shares dropped to 330p. Where do I start? A 48% decline in profits. I can start there to 1.38 billion. Gas refining and trading was the weak spot with BP. Profits attributable to shareholders fell to 687 million dollars rather. At least it was an improvement on the $2 billion loss that we saw in Q4, and that's profit attributable to shareholders. I'm not talking about the other metric that they use for profits. Sustainability chief, easy for me to say, is going. She's the architect behind the move to renewables. So I think that's the least
long overdue.
It should have happened a year ago. So I suppose it's better late than never. But for me, while Elliott Investment Management appears to be getting the change it's calling for, markets aren't convinced. And to be quite honest, neither am I. I still think they need a new CEO. They need a new person to drive this change, because current CEO held out for way too long. And the only reason he's doing this is because he's being forced to do it.
Yes.
And while not all of the shareholders are happy about it, Legal & General has come out and basically said that they don't approve of this move back towards fossil fuels. But ultimately, a company, BP, is there to make the best use of shareholders' funds. And make money.
And that they haven't, to be completely honest, they haven't done that for years.
No.
And no, I think you're absolutely right. I mean, you recap the results in full there. There's really not anything to like about that, to be completely honest with you. I mean, you can go on, you look at the buyback, it was right at the bottom of market expectations.
But why are they doing buybacks, Michael? They need the cash, right?
Well, I think I would imagine the only reason they're doing buybacks is because they've guided towards having done it. If they'd scrapped that, then we'd be trading even lower than we are. Yeah, but as you say, it is. I'm always slightly sceptical when companies start to buy back their own stock. It sort of suggests to me, are they a little bit out of ideas as to what else they can do with the cash in terms of innovation and growth? And the best thing they can do is buy their own equity back with it. Certainly in an instance like BP, where, as you say, they need the cash and their net debt pile is back at its levels it was at in 2021, 2022. Going and spending £1 billion buying back a load of shares is, I would argue, not the best use of the funds that you have available.
But for me, hard decisions need to be made. And if scrapping the buyback is one of those decisions, basically where the share price decline, draw a line under it, say, right, this is what we're going to be doing for this cash. And if we're not going to be spending it on CapEx or putting it into the business, then we should be using it to pay down debt.
Yeah, no, I think you're right. And I think that the sort of overarching takeaways for me are, one, what we've just discussed there, I think just sort of epitomizes the mismanagement that's plagued the firm for quite some time now. And secondly, there is absolutely nothing in that slate of earnings that's going to make Elliott turn around and go, oh, fine, well, we'll back down now. I think if anything, they're going to double down because, as you say, clearly progress needs to be made much, much quicker than it is being at the moment.
They've been buying back shares every single quarter for about the past 2 years. In that time, the share price has gone from 550p to 330p. So what value has it added? Absolutely zero. None. So they could have put that capital to much better use.
Yeah, and you think that they've probably been doing a billion or so every one of those quarters as well. Yeah, it's not...
I mean, BP has a target to reduce its debt between $14 billion and $18 billion by the end of 2027. We're almost halfway through 2025 and it currently sits at $27 billion. So where are they going to find that $10 billion from? It's not just going to be from asset disposals. They're going to have to make other savings somewhere else, or they're going to have to generate more money.
Yeah, absolutely. And it's not just going to sort of appear from under the mattress one morning either, is it? So, yeah, clearly the turnaround there, if you can call it that, needs a fair chunk more work.
Yeah, it certainly does. So BP, get your act together, because you're certainly not going to have a white knight coming in to bail you out.
No, absolutely not.
All right. Associated British Foods, we talked about them last week, otherwise known as Primark. They were an interesting set of numbers. No surprises to see that obviously the UK and Ireland business was somewhat disappointing. H1 revenues fell 2% to £9.5 billion and profits before tax fell 21% to £692 million. But the sell-off was on disappointment over the performance of its sugar business, which gave shareholders a little bit of a bitter taste.
God, these are getting worse.
They are, aren't they?
I've got nothing to come back to with that either. I mean, dearie me, where do you even start? Definitely not sweet, that's for sure. God. So we turn back to a more serious matter.
So on a more serious note, the sugar business obviously was the drag.
Yes, it was.
There has been some talk. There was talk earlier this week that maybe they should spin that off. But I think one of the attractions of Associated British Foods is it's a very diverse business and it served it well during the pandemic. So do you suddenly cut an underperforming business loose just because it's underperforming? I mean, these businesses generally tend to be cyclical in nature. So while it's poorly performing now, it doesn't necessarily mean that it will continue to do so.
No, you're absolutely right, and particularly they are a very, very diversified firm, as we know. And I think naturally the sugar business is going to be the most volatile part of that. But as you say, it's all well and good sort of sitting here now and going, well, that was the big drag on earnings, margin shrank, etc., etc., etc. They should get rid of it. Well, what happens in 2 years' time if consumer spending has fallen off a cliff and actually it's the sugar business that's making up for a real slump in sales in, say, Primark, for example? Then they're going to be very, very glad that they kept hold of it. So, yeah, I think they should avoid being particularly hasty on this front. And I think, to be completely honest with you, the downside that we saw post earnings is arguably a bit of an overreaction, given that it's one line of the business that's very volatile that has dragged everything lower with it. And if you can take that out of the equation, just mentally, when you're looking at the numbers, things are actually okay.
Yeah, I mean, there was an operating loss of 40 million for this financial year. All the other businesses performed reasonably well. And what was interesting about the Primark business was that even though the UK business, which makes up 46% of overall sales, saw a 4% decline, the US makes up 5% of sales, saw growth of 17%. Spain and Portugal, which make up 18% of sales, an 8% increase, and France and Italy, 4% increase on a 16% of sales. So the growing European and US businesses, even though they make up, the minority of overall sales, are tending to generate an awful lot more revenue now.
Yes.
And as a consequence of that, are quite likely to help offset some of the weakness that we're seeing here in the UK and Ireland. So,
yeah, definitely.
And obviously, Primark's or ABF's diverse nature of its business helped it during the pandemic. I'm struggling today.
Got there in the end.
I think I need a drink.
I hope that's water in there.
Of course it is, mate. Yeah. So yeah, I mean, basically, that's Associated British Foods. So they were a bit disappointing. AstraZeneca disappointing. Rolls-Royce impromptu trading update. They just reaffirmed the guidance essentially for this year, and they said that they were putting in steps to mitigate any adverse effects from tariffs. So 2.7 billion to 2.9 billion pounds free cash flow and underlying operating profit. They reiterated that and said that long-term engine flying hours are now at 110% of 2019 levels. So essentially onwards and upwards. And a final tender to Great British Nuclear was submitted in April for single modular reactors with a decision expected in June. Let's hope the UK government rubber stamps it.
Well,
given what happened in Spain and Portugal,
Yes.
We need a.
We do. We absolutely do. We certainly don't have time to discuss this now because we'll both go off on a bit of a rant. But all I'll say is I won't be holding my breath for the government to make the right decision on that.
No, neither will I. Unfortunately, we've got a bunch of clowns in power at the moment. Okay, so less said about that, the better. Moving swiftly on. US tech.
Yes.
Okay, so Alphabet.
Of course, we await Amazon and Apple after the close this evening.
Sadly, we won't be able to cover them next week because I'm away next week, so there will be no podcast. I won't be hosting podcast.
Indeed. But we did have Microsoft and Meta, as you say.
And Alphabet's Google last week.
Pretty strong.
All good.
Yeah.
All good.
Very strong.
Alphabet. Okay. Shall I do the numbers?
Go for it.
Okay. Alphabet's first quarter numbers, 4% increase in revenues to $90.2 billion. Income from search and advertising holding up well. Now, if the economy was slowing down, you would expect to see the effects of that in search and advertising, and we're not really seeing any evidence of that at the moment. $50.7 billion, up from $46.15 billion a year ago. YouTube ads, $8.9 billion, a $900 million increase in the same quarter last year. Cloud also saw a big jump, 12.26 billion, up from 9.5 billion. Net income rose 46% to $34.5 billion from $23.6 billion. Operating margins higher. Is there nothing that this company can't do? Up from 32% to 34%, despite losses in its other bets division, which includes Waymo. Waymo losses $1.2 billion.
Which, when you're delivering numbers like that, let's be honest, you can probably wear it, can't you?
Yeah. And I think one of the main reasons for the losses in Waymo is because they're scaling that business up.
Yes.
So you're going to get sunk costs, if you like. Self-driving taxis, that is, San Francisco, LA, Phoenix, and Austin. And they kept their CapEx guidance of $75 billion unchanged. And that was a similar theme that we got from Meta and Microsoft as well. Their CapEx numbers are very, very high.
Yeah, and again, I think that's interesting because, as you say, again, you're kind of looking at all of these reports, not only for how the company in question is performing, but as a sort of bellwether and a barometer of the economy at large. And you take those three big tech names, Alphabet, Microsoft, and Meta, all of them are continuing with huge amounts of capital expenditure, which if they were expecting things to worsen considerably, they would not do. And also, as you rightly said, advertising revenue has held up and it's guided to continue holding up very, very well. And again, if everyone was expecting or in the midst of a significant slowdown, you would expect ad revenues to be one of the first things that firms look to pull back on. So again, I mean, I guess it goes back to the question you asked earlier about the UK economy. Is it the calm before the storm? And it's Q1, so it's sort of immune from all of the tariff nonsense that we've heard since. Or is it a case of actually maybe we got far too pessimistic on how things may turn out?
Similar story, Microsoft. They're higher again today. US markets just opened. They're up just over 2%. I think they were up more than that in the pre-market, post the numbers last night. But again, saw cloud services, Azure, saw revenue growth of 33%, and guidance was for 32. Guidance was $67 to $68 billion, revenue $71 billion, up 15%. Other business areas were strong. Microsoft Cloud revenue was $42.4 billion. Personal computing saw a 6% increase in revenue as well to $13.4 billion. Now, personal computing, PCs are an expensive piece of kit.
Yes.
So if and obviously I think businesses generally tend to buy an awful lot of for remote working and that sort of thing. But businesses, again, don't invest and spend an awful lots of money on kit, or consumers for that matter, if they're concerned about the economic outlook. So again, here it looks fairly strong. And the guidance for Microsoft's Q3 numbers. I don't know why they can't keep the same quarters from company to company.
Oh no, that always winds me up as well, actually.
Alphabet's Q1 results, these are Microsoft's Q3 results.
Yeah, I'm just stubborn these days. I'm just going to go by the calendar quarters, and they can fiddle with their financial accounts how they want to.
Yeah, but you're just confused people when you talk to clients. You think, what's that, the 2 or whatever?
I do that anyway.
Well, yeah. Microsoft's Q4 guidance was to deliver revenue between $73 and $74.25 billion. So almost $4 billion increase. So they're not.
Huge.
That's a huge jump. And Azure revenue guidance was increased to between 34 and 35% revenue growth from 33%. So again, I'm struggling with the narrative here of the doom and gloom on the one side and the guidance that we're getting on the other. Meta, again, I don't really want to talk about Meta because at the moment,
for obvious reasons.
For obvious reasons, I'm having discussions. But they've reported another strong quarter. Total revenue, $42.3 billion in their latest numbers, a rise of 16%. Revenue from the family of apps came in at $41.9 billion, an increase of almost $5 billion. Income, $21.7 billion. I've got to be very careful what I say here.
Yeah. Well, no, but I think the
sponsored posts and what have you. But
setting that to one side, I think the broader point remains correct in that nothing that has been delivered in terms of the black and white figures, all the guidance from these firms, the tech names at the very least, suggests that they have any huge impending imminent sense of doom over the US economy. Now, I would caution, obviously we've not got any time to discuss this. We have seen a number of firms withdraw their guidance as a result of the tariff-related uncertainty. But this goes back to a point we were making last week in that, is there a degree of insulation from tariffs that these tech firms have, particularly the service providers like Microsoft and like Meta? And that's why, and as you said, we're not going to have a chance to discuss it next week, but I think the Apple and the Amazon numbers are going to be particularly interesting because, yes, they've got the cloud business, yes, they've got all the AI stuff, but they're also shipping physical products all over the place. And they've got, well, certainly Apple have got production that they need to potentially reshore. So I think they're going to be very, very interesting. I guess we should probably talk about the week ahead because that's pretty busy as well, isn't it?
Yeah, I'm just going to finish off by saying Meta's CapEx, they raised it to between $64 billion and $72 billion. AI, again. And Microsoft, $80 billion earmarked for the current fiscal year. Although they did say that higher costs could impact this due to tariffs. So there was a slight caveat with Microsoft. But yeah, just before we move on to the week ahead, Travis Perkins reported this week. Much of a muchness, really. Numbers weren't great. Toolstation division doing the lion's share of the heavy lifting. Group revenue fell 2.4%, with the merchanting division, or the builders merchant division, seeing a 3.5% fall. Toolstation, on the other hand, reported a 2.8% rise. Now, if there's a case for splitting the business,
I was going to say, it doesn't get much clearer than that, does it?
Can't get much clearer than that. I mean, talking about splitting up Associated British Foods, how about Travis Perkins and spinning off a Toolstation, because that appears to be the screw fix or for equivalent of the Travis Perkins. Having said that, their shares are up this week, so maybe the bottom is in and we could start to see further gains. I mean, I suppose the question is, how much worse can it get?
Well, let's not tempt fate on that front, but of course they are looking for a new chief executive, and it seems like you've just thrown your hat in the ring. So all the very best with your application, Mr. Hewson.
Probably the wrong type of tool, as they say.
Oh God. Oh.
Anyway, so that's this week.
The rainforest of paper that makes up the last week.
I think one of the things that really frustrates me about earnings weeks like this, particularly with UK companies, they all report on the same day.
Yes.
And you end up as an analyst sitting down at 7 a.m. in the morning as all of these RNS announcements hit the tape. And you think, how have I got to make sense of this between now and 8 o'clock in the morning? In an hour. You just can't do it. And I think there is a hope, there's this expectation sometime. It's a good day to bury bad news. The problem with that is that if you have a really good set of numbers, they get lost in the fog of everything else. Which is why sometimes you get a delayed market reaction, because it takes so long for people to read through all these different RNS announcements. And you get the share price reaction 2 or 3 days later, as opposed to straight after the numbers.
Yeah, no, you're absolutely right. And I think it is an important point, because ultimately, whether you be an analyst or an investor or a short-term trader, whatever, we're all reading it ourselves and we're all going through it slowly but surely. And certainly, if you've got 5 companies dropping earnings and a random news release happens to pop up, well, let me tell you now, the random news release is the one you're going to get to last, because you've got all these major earnings to get through. So yeah, I think that is a very, very good point.
Okay, so next week We've got Federal Reserve, we've
We
got
do.
Bank of England, and we've also got Next's first quarter numbers, IAG, JD Wetherspoon, Disney, Uber,
Hmm.
and DoorDash. Now, we're not going to get through all of these, but you can read about them on my Substack. But I do want to talk about DoorDash because they've put in a bid for Deliveroo.
Indeed. Well, take it away.
Okay, so Deliveroo, we were talking about them last week. IPO'd at 390p, and now DoorDash have come in with a cheeky offer of about 180p.
Hmm.
You look at DoorDash when it IPO'd, it underwent a similar share price drop and then rebound on the back of COVID because everyone was basically, getting deliveries, eating at
Yeah.
home. How has DoorDash somehow done so much better than Deliveroo that it's in a position to be able to basically pick up Deliveroo supposedly on the cheap?
Yeah, it is a very good question because, as you say, there are huge sort of parallels between the two companies. I guess the cynic in me would say this is actually just the latest part of a much broader trend where you have US firms sweeping into the UK market to pick up what they see as cheap and undervalued companies. And this is just the latest chapter in, well, I don't even know how many chapters there are in this saga now, because it feels like probably once or twice a month there's a predatory bid from overseas for a UK firm. And yeah, Deliveroo are the latest one to fall victim to it, I suppose.
Yeah, I think it speaks volumes that while DoorDash has been able to basically recover
Hmm.
and pretty much all of its IPO losses, Deliveroo hasn't. And I think
Yes.
that doesn't say anything about the fact that Deliveroo are any less better or any worse.
Hmm.
DoorDash only started to turn a profit 6 months ago,
Yeah.
last 2 quarters. Same with Deliveroo. So I read somewhere, I won't mention the newspaper, there's a really critical article about Deliveroo.
Hmm.
But for me, I think there isn't really that much of a difference between the two companies, except for the fact that DoorDash is worth probably 10 times as much as Deliveroo.
Yeah, which I think speaks to the differing degrees of comfort, I suppose you could phrase it as, on either side of the Atlantic with investing in tech or platform providers. You know, those firms, those sort of firms in the United States attract much higher valuations than they do here. And I think this is a tale that evidences that.
We've lost Just Eat, now we're losing Deliveroo.
Indeed. As long as their riders hang around, then
Welcome to the UK, where basically valuations are cheap and they don't last very long because they
no.
get taken over.
Exactly. Well, exactly that. Either valuation stays cheap or they disappear. They're basically
Yeah.
the options at the moment.
Right. So anyway, Federal Reserve.
Well, they're not going
Powell's,
to do anything.
we're not going to do anything, but Powell, he's in a difficult situation. US GDP, talk to me about it. 0.3% contraction.
Yes, well, if
Is
you
it real?
ask, well, it is real, yes. If you ask the White House trade advisor, Peter Navarro, it's apparently the best negative GDP print ever. But I think it's probably best I don't talk about that anymore because we'll get taken off air. The reason why the economy contracted in the first quarter is basically because of this massive surge in imports. Imports actually took 5 percentage points off GDP in Q1, and it was the biggest negative contribution on record from the net exports component. All that's happened is US firms in the first quarter, they know Trump's come into office, they know tariffs are going to be put in place, so they've gone, well, we're going to get our imports in now, so we don't have to pay a tariff, rather than waiting for 3 months down the line when we need the product and we're going to have to pay a tariff on it. We'd rather just leave it in inventory in the meantime instead. So that's why we saw the economy contract. I think there's two things I would add to that. One is that that's fine, but what we're looking at here is Q1, where we're dealing with tariff uncertainty. As you move into Q2 and Q3, you then go to actually the tariffs being introduced. You also have the uncertainty having continued, and you have a much greater amount of government spending cuts that are likely to come into the data as well. So if you go back to your economics 101 model, that's when you start to go, well, maybe the net exports component will be fine, but actually consumption and government investment and private investment are all likely to face quite stiff headwind. The other part of GDP that was concerning was the PCE number, which came in at 3.5%. So not only have you got an economy that contracted, you've also got an economy where price pressures were very, very intense during that first 3 months of the year. So as you say, for the Fed, and as we were alluding to earlier, Powell and his colleagues are sort of stuck between a rock and a hard place on this one.
Yeah, I mean, I actually looked at the numbers. So it's the same one as you did. Personal consumption and investment actually held up well. Now, that import number should reverse in Q2.
It should. Well, it almost certainly will. Yeah.
So that would mean that the economy should bounce back by that reasoning, surely, because you're
If
not going to
everything
get
else
such a big,
continues to hold up.
yeah, exactly.
Yeah.
So for me, even though the economy contracted, it was basically because everyone basically piled in and basically got their imports in early. Now they've got an added cost of storage
Yes.
of all of those components, because unless they shift them quickly, you're going to get an inventory build up,
Yeah.
and that's going to act as a cost going forward for
Yeah.
company earnings.
No, you're absolutely spot on with that one. But in terms of the Fed, they're certainly not going to be making any changes to the Fed funds rate this week. I would imagine that the statement will downwardly revise their expectations in terms of growth and note how risks around the outlook have become more elevated. They're just really going to play for time, to be completely honest with you. And the press conference, Powell is going to get absolutely peppered with questions about politics, and he will not, and nor should he, answer any of them or even entertain them, to be honest.
No, I think he has to shut them down early.
Yeah. Well, he was asked, I was watching a clip of this, I think it was last July. He was asked by one of the journos at the press conference if President Trump was elected, because of course he wasn't in office at that point, and asked you to resign, would you? And Powell just went, no. And then they went straight to the next question. And that's the
Nor
perfect answer to give.
Or should he?
Absolutely.
Because he's basically serving a greater purpose being there
Yes.
than he is if he were to step down.
No, 100%. But I think
for financial stability reasons alone, he needs to stay.
yes, absolutely. But I think the BOE will probably be considerably more interesting.
Yeah, 4 rate cuts between now and the same time next year.
Well, do you know what? If you put that to me this time last week, I'd have gone, that's completely loopy, no chance. But we did hear from the governor of the Bank of England last week, Andrew Bailey. He was speaking in Washington, and he made some quite interesting comments where the essence of the interview that he gave was really downplaying the risks of inflation becoming persistent within the UK economy and really focusing on the growth shock, as he termed it, that tariffs are likely to inflict. We then, of course, last week had utterly dismal flash PMI numbers, everything in contraction. I think it was a 29-month low on the composite PMI figure. So you sort of put those two together and you actually say, well, the data is starting to soften, survey data, I know. The bank are making increasing noises that actually growth is playing a much bigger part in their calculus than it probably was 6 months ago. So I can actually see the MPC opening the door to the idea of consecutive rate cuts at the May meeting. And it would be very easy for them to do that because they've been speaking thus far this cycle about needing to remove restriction in a gradual and careful manner. All they need to do is alter those two words, and all of a sudden you've opened the door to going May, June, August, September.
Do you think it's likely though?
I do, to be honest. I think inflation is going to continue moving higher, don't get me wrong. But I think the bank are going to take a view that says the path of inflation this year has been below the profile that they forecast in the February monetary policy report. Services CPI in particular has been notably soft. And I think the bank are going to probably take the view that, yes, there will be this hump in inflation as the impact of tariffs comes through and as the national insurance changes, et cetera, et cetera. But I think they're going to bet that it is a hump and actually that the focus should fall on growth. I'm not saying that's necessarily the right call. If I was sat on the MPC, it's probably not the call I would be making. But I think it's the path that they're likely to go down, particularly when you've already got people like Dingra and Alan Taylor, two of the external members, who are sounding very dovish in recent remarks. It's not going to take a lot for the internals to join that group, and you're off and running.
Yeah, but if you're talking Dingra, you're talking to you're preaching to the choir there. She's been dovish for as long as I can remember.
Oh no,
there's no surprise there. Will we get a 25 basis point cut next week? Yeah, probably
yes.
we will. I think what was particularly instructive last week, or was it this week, was the comments that Megan Green made about inflation or deflation, disinflation. She's one of the more hawkish members of the MPC.
She is.
I mean, she called for a rate cut, not a rate cut, a rate hike, I think fairly recently. I think it was about a year ago.
Yeah, she was sort of last woman standing, wasn't she, on that front?
And in a speech that she made to Bloomberg, well, not a speech, but in an interview with Bloomberg, she said that tariffs could be deflationary. And if she really thinks that, then it's not going to take much for her to start calling for rate cuts herself. So I'll be very interested to hear or see what she has to say.
Yeah, and I think the
in
vote
the coming
split,
weeks and months, and the vote split most
that will be
definitely. Because
really interesting.
for me,
Not only, sorry to interrupt, I was going to say not only, the cut unchanged split, but also is anyone in the 50 basis point cap?
yeah, I don't think she won't be.
Oh,
I
no, no,
guarantee
no,
you
she
that
won't
she
be.
won't be.
Dingra will be.
But I think her views on sort of inflation, and obviously I think it's a May inflation report, isn't it? It's the
Yes, it will be,
Yeah,
yeah.
so there'll be new economic projections, and so new growth forecasts, new inflation forecasts. Now the current inflation forecast is 3.7%.
Hmm.
Be interesting to see if they cut that.
I think that will come down because of those two factors, the disinflationary impact of tariffs and the lower year-to-date profile.
Might be worth asking. Might be worth asking Andrew Sentence whether his 5% target has come down.
Yes, that's a very good point. We should do that.
Should I might send him a message on his social media, see if he's inclined to come on again at some point.
Yes.
Okay, so rate cut next week from the Bank of England, a Federal Reserve on hold.
Hmm.
We've got first quarter numbers from Next. I think they'll be interesting in the context of what we saw from Primark, some sales numbers this week. The thing with Next, Michael, is that they're a UK retailer, and yet every single quarter over the last few years, they've raised their guidance.
Yes.
And it'll be very interesting to see whether or not they raise their guidance again, because when they reported their first quarter numbers, that's not the first quarter, their full year numbers, they raised their guidance for this coming year. I mean, obviously, it's got equity stakes in Fat Base and Joules, so obviously the sales there get
Yeah.
included in the numbers. But pre-tax profit guidance was increased by £20 million in their end of year numbers to £1.06 billion
Hmm.
for this current fiscal year. I think for me, will this run of guidance upgrades continue? Because at some point it's going to have to end. And what will that do to the share price? Because I'm looking at the next share price, and it's pretty much close to record highs, if not trading at record highs.
And I think that's the point. It's a case of the precedent is next report earnings, next upgrade their guidance. It's almost taken as night follows day, so to speak. And absolutely, I think if that is the key thing to watch, if they do maintain, even maintaining guidance, they don't necessarily need to downgrade it, just maintaining it where it is would be a little bit of a red flag in my mind.
The shares are traded at new record highs today.
Well, we'll see if they're still there after earnings, I suppose.
Yes, indeed. We've also got AIG, British Airways. Obviously, there's been some chatter that travel to the US may well get hit on the back of obviously what's been going on with politics. People have been put off traveling to the US, so their first quarter numbers should be fairly interesting. I always think that it's rather strange that you're put off going to the US just because the president said some things that maybe don't suit your political affiliation. The US is still a great destination for holidays. Why would you punish working people in the US and not go to the US for the loudmouth actions of your president?
No, I've never understood that. I mean, to be completely honest with you, when I choose a holiday destination, I'm thinking, what do I want to go and see, or how
Yeah,
hot is it going to be,
yeah.
and do I need to pack a hat to cover up my bald head? Not who is in charge in that country. That does not come into the equation whatsoever. To be completely honest, when I'm spending 2 weeks there on a sun lounger, what the president of that country, unless he launches a bloody coup or something, it really doesn't come into the equation at all.
I go to the US on a fairly regular basis. Doesn't care.
No.
I don't know who the
Why
bloody
would you?
president
I
is.
mean, I don't think people, the same example, I don't think people
Honestly,
have sat there in
get a
America
life.
or
Get a life,
France.
people.
I don't think anyone else sat there outside the UK going, I'm not going to visit London because Keir Starmer's there. You're not going to have to go for a beer with him.
No,
Anyway.
not that I'd want to.
No, nor would I actually.
JD Wetherspoons, your favourite pub chain, mate, they're also reporting third quarter numbers. And we've seen a fairly decent recovery in the share price
Yes,
since
we
we
have.
last spoke about that. And I think a large part of that was down to that confidence you gave them, which I think went viral on TikTok.
It did. If Tim Martin wants to buy me a pint for the vote of confidence we seem to have given his company, then he's more than welcome to. No, I think you're right. The stock has recovered quite nicely recently. But again, the earnings are going to be interesting for the guidance that they may issue and the commentary that they have around the UK consumer, I think, just in general.
Yeah, I mean, Tim Martin's never been one of these people who's been, he's never shy about basically slagging off the government of the day. And he did point to the fact that obviously all these changes have added 60 million to the company's cost. Food sales 5.4% increase, bar sales of 4.3%. Like for like sales doing well. They're refurbishing pubs. They're getting rid of ones they don't want. Ultimately, it's a well-run business.
Yeah, absolutely. There's still a hell of a lot to like about it, and clearly the national insurance changes are going to be a headwind for them. They're going to be a headwind for everyone. But you would perhaps argue that given their size within the sector, they may be able to weather that slightly better than their peers and their competitors.
Right, we're going to finish off with Disney. I'm going to skip Uber because,
Taxi for
rideshare,
them.
taxi firm. And I did use them a lot when I was in the US in January,
Well,
February.
it
So
works in the US. This
it
is the
does
thing.
work.
If you order an Uber in London, you stand on the side of the street for half an hour and he never turns up and he cancels on you 15 times. If you're in the US, then 30 seconds and you're going where you want to go.
We landed in San Francisco, thought, okay, how do we get to the hotel? Dialed up Uber on my app. He was there within 5 minutes. Job
Yeah.
done. And he was a really nice chap.
And having
Really
said we weren't
friendly.
going to talk about Uber, we then just
We've just gone and done that. Anyway, Disney's second quarter numbers. Streaming business is still struggling in terms of subscriber numbers. It's losing subscribers, but it is now profitable. But I think the problem that Bob Iger's got is that the share price recently hit its lowest levels since September 2023. So investors don't appear to be that convinced. Having said that, peak season now for Disney in the parks, cruises, holidays.
yeah.
If it can't do well in the next 6 months, then what is it for?
Yeah, no, I would completely agree with you on that one. I think, the streaming concerns are valid, but now is really crunch time for the firm. This is going into the absolute peak of peak season, and yeah, absolutely. If they can't perform now, then they're probably never going to.
Absolutely. So what we want to see is a move back through $100. Bottomed out around about $80 in the sell-off. At the start of this year, is up near $115. So I would hope to see an improvement in the fortunes of Disney. But again, maybe they're suffering on the back of the fact that European visitors are going to stay away. Again,
Yeah, possibly.
going back to my previous point about British Airways and IAG, I mean, I think if you're basing a decision on where to go on holiday based on the president of that country, I think your options are going to be very, very limited.
Incredibly so. Yeah, absolutely.
I mean, let's face it, if I took that attitude, I wouldn't go to Canada because Mark Carney's Prime Minister.
No.
I think the guy's a complete
We
loser.
really should end it because we're going down a proper rabbit hole if we speak about him.
I love Canada. I think it's a great place. Absolute great place. Anyway, so we've gone slightly over the hour. Sorry about that, ladies and gentlemen, but hopefully what we've discussed has been instructive, and I'll speak to you all same time, same place in a couple of weeks' time. Good luck with the Bank of England and the Fed, Michael. I'm sure you won't need it.
Thank you, mate. See you later.
All right, cheers.